Hey everyone, the stock market has been in rally mode driven by the growth of AI stocks, so it's been more difficult to find cheaper valuation stocks to buy at attractive prices. That's what I'm going to bring you in this video. DigitalOcean Holdings is one growth stock that's down 74% off the high that I think you might regret missing out on. I'm going to share with you the details of this company, its historical or previous few years revenue growth, operating profit, cash flow. And then I'm going to look at the next 5 years, the growth rate expectations, and put it all up against its valuation for my reasoning why this growth stock makes an excellent investment. So let's take a deeper look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So DigitalOcean Holdings, like I mentioned, is down 74% off the highs reached in 2021. Of course, the stock kind of bottomed in 2023 and has recovered nicely. And that's followed trends in the enterprise spending industry. DigitalOcean focuses on smaller businesses, those that don't get served as well by the large cloud providers, because it can be more difficult to onboard a smaller business that may not have the specific technical skills to implement the services provided by the larger cloud providers. And so DigitalOcean serves that market. And I think that's an attractive market opportunity because more and more smaller businesses are coming online, becoming digital, and they need those cloud services. And so there needs to be a bridge between those two services. And so DigitalOcean, I think, is serving a nice market opportunity here. And longer term, I like its prospects. Now, one of the key things I've liked about DigitalOcean is the company's free cash flow generating abilities. You can see here in fiscal year 2022, it generated $78 million in adjusted free cash flow, and that jumped up to $156 million in adjusted free cash flow in 2023. That's expected to remain flat here in 2024 at $154 million. That's one of the reasons the stock price has not jumped in 2024 is because the cash flow expectations remained flat. But one of the risks it helped alleviate for me in the most recent quarter is an increase in the net dollar retention rate. This is a metric that had been declining for DigitalOcean Holding, along with the broader market where businesses were cutting spending in their cloud services. And that had been a trend that started in late 2022 and continued throughout 2023. But several companies have indicated that spending has increased now, and DigitalOcean is one that highlighted net dollar retention rate increased to 97%, up from 96%. It's a small increase, but what matters is it ended the trend, right? This was like several consecutive quarters of just declining net dollar retention rate, and now it increased to 97%. But let me remind you folks what the net dollar retention rate measures. It measures how much an existing customer spends with your business in its second year. So if this number is above 100%, that means an existing customer spent more with you in its second year than it did in the first year. And that's a sign that you're delivering a good return on investment, because otherwise, why would a business spend more with you this year in the second year than it did in the first year if it didn't like what it got in the first year? So at 97%, it's slightly decreasing year over year. And that follows that trend that I discussed earlier, where businesses were looking to cut spending in discretionary categories. And this was one of those discretionary categories. And it's because businesses were afraid of an oncoming recession. And smaller businesses, like the ones that DigitalOcean serves, have to be even more cautious than bigger businesses, because smaller businesses generally don't have the access to credit in the event of poor outcomes like a bigger business might, right? If you're a company like Apple or Home Depot or Amazon, if there's a recession and you need cash for some reason, you can find it relatively easy to go out and borrow money or raise money. But if you're a smaller business, think someone like with 22 employees, right? Just a smaller private company, your access to capital is much more restricted. And that becomes even more restricted during difficult business conditions. If you try to go out to borrow money, you'll find it very difficult. Or if you are able to access credit, you'll have to pay very high percentage rates. And so these businesses are more likely to cut spending earlier when they notice any sign of trouble. They cut spending earlier than larger businesses might. So you can understand that decreasing spending from DigitalOcean customers started earlier than larger business becoming more cautious. But now, as we notice macroeconomic performance much better than expected, spending is rebounding again from enterprises, and DigitalOcean customers likely boosted their spending. You can see that with the average revenue per user as well, increasing from $92.63 up to $95.13 in the latest quarter. If we look back longer term, DigitalOcean had increased revenue more than double from the $300 million in 2021 up to $712 million in trailing 12-month revenue in the most recent trailing 12-month period. Profitability expanded with growing revenue up to 7.93% operating profit margin, up from negative 5% in 2021. Similar story with cash flow from operations, although this number looks much better because DigitalOcean uses stock-based compensation, which is a non-cash expense, which makes its cash flow look better than operating profitability. And 37.25% is an excellent number for this metric, up from a little over 18%, more than twice that rate. So it's making good progress in expanding the key profit margins, expanding revenue, and hitting a key market opportunity that some of the bigger players may not want to address or may not have the ability to address because these businesses are too small to be worthwhile for some of the larger companies to attract. Now, looking ahead, the company is expected to grow earnings per share by 12.4% per year over the next 5 years, according to the Wall Street analysts that are following DigitalOcean stock, which is a relatively solid earnings per share growth rate over the next 5 years. It's about what is expected by the average company in the S&P 500 over the next 5 years. And so you can understand why I've had DigitalOcean stock rated as a buy, and I reiterated that recommendation today. And of course, it helps that the valuation is relatively cheap, trading at a forward price to earnings of 18.31. I think this company at current valuations is an excellent investment, and I have it rated as a buy right now on my stock recommendation list. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.